Thank you all for being here today. We are the Louis Wilson Fund of Milsaps College, and we are presenting Chicago, Virgin Islands. I'm Dak Cunningham.
Keegan Joplin.
Mary Elizabeth O'Leary.
Jake Sherrington.
And I'm Will Birch. Chicago Bridge & Iron is a fascinating engineering and construction company that was founded in 1809, and through a series of acquisitions and steady growth have become one of the leaders in the industry. Right now they're in the process of acquiring the Shaw Group, which will add a lot of diversity to the company. Right now they service projects from front-end engineering design to distribution. Here you can see our intrinsic value of $52. That's PE, EV to EBITDA, as well as a free cash flow to the firm. And then we have a one-year target price of $57. That is EV to EBITDA and PE, and Zach will discuss that later. Here are the segments before the acquisition. You can see the revenues from the PEC segment make up the largest portion. And steel plate structures, this is really diverse, serve a lot of end markets, lots of different steel structures. And this has the largest portion of net income, wider margins. And then we have Lumis Technology. That was acquired in 2007, really advanced proprietary technology, services the petrochemical industry, has really wide margins, really advanced. Here you can see the transaction value. $3.2 billion transaction deal. It's going to be $41 in cash and 0.1288 shares of CBI for each Shaw share. We view it as a really good acquisition due to the synergies that it's going to offer and some of the diversity that it's going to offer. You can see that in our EV/EBITDA decrease from 2012 to 2013. And here's what Shaw brings to the acquisition. You can see that how heavily power-oriented they are. They have the power segment and plant services, mutually beneficial. They can build these power plants and then service those later, offering a pretty steady stream of revenue. We have environmental and infrastructure, and this is public and private reimbursable contracts, offer some margin protection. And then we have fabrication and manufacturing. And this is going to be really big for CB&I because they can offer the piping on these projects, and it's prefabricated pipe that they just suit for these projects.
So we're very optimistic of CBI's end markets, starting with LNG or liquefied natural gas. With the gas shale boom, the U.S. has increased their natural gas reserves substantially. We see this as an opportunity for those companies that can export LNG and reach those foreign markets. We think CBI will succeed in doing so with Shaw's fabrication capabilities, as well as CBI's already major role in LNG. Gas to liquids, or GTL. Shell and Sasol both made plans in Louisiana for GTL projects, and we see this as an opportunity because Shaw is headquartered in Louisiana. Oil and sands. Right now, the oil and sands market is flourishing within Canadian waters, where CBI has been involved. Those awards have been going for $100 million to $1 billion each, and we expect CBI to stay involved in those in the future. As you can see, in the past few years, oil supply has remained stagnant with a slight increase in oil demand, so we foresee an increase in oil prices in the future, which could add some revenue to that market. Moving on to petrochemicals. Right now, CBI is in an ideal position. They can both license and perform those EPC-related projects. Also, as you can see, Chevron and Dow, two major producers, have announced future investments in petrochemicals, and we see that as a precursor for future growth. Moving on to power generation, with Shaw being a major player in power, we see that as a huge opportunity for CBI, especially with the growing energy consumption, especially with your emerging markets like China and India. Environmental, now that we've acquired Shaw, we do have the ability to retrofit those facilities that don't meet EPA standards. We think there's approximately a $50 market there in the next 5 to 10 years. And lastly, infrastructure. The infrastructure market is looking good as well, especially with the energy infrastructure. There's about 95 $1 billion mega projects planned this year and beyond. So, Jake.
CBI has 4 main competitors, Fluor being the strongest of the 4. Its oil and gas segment has shown steady growth in North America, and it's produced a backlog of approximately $43 billion. Its industrial and infrastructure segment has been one of the primary reasons its revenue has recently increased. As well, they've recently increased their number of projects by completing several multi-billion-dollar petrochemical complexes in the Middle East, China, and Europe. Listed are a few operational risks. The state of the economy is heavily dependent on the amount of awards that are received by these companies. 2009 was a great example of this. With the increased amount of competition, this puts more pressure on company advisors to bid on projects. But thankfully, since CBI is a diverse company, like as Will spoke about, This will allow them to receive more projects in the future. And in terms of the EPC projects, are heavily dependent on the risks that the companies take on when they state how much a project will cost. Using a lump sum project puts greater risk on margins. And finally, risks to the price target. Just several are listed. A few to take note of is that it's currently selling its 52-week high, which puts it at risk right now if you were to invest in it. And also, if oil and gas prices were to fall in the future, this could cause for the delayment of projects or cancellations of projects.
After the acquisition, CBI will more than double its revenue, which we use to project a future revenue growth rate of 10%. We also brought in multiple different factors. The energy infrastructure, like Keegan mentioned, seems to be growing, which offers more investment opportunities. Additionally, we looked at the combined backlog, which is $27 billion with CBI and Shaw. CBI brings $9.5 billion and Shaw brings $18 billion to that backlog. And in the top graph, you can see where the revenue seems to double between 2012 and 2013. We also looked at the cost-saving synergies. First-day cost-saving synergies will be roughly $30 to $40 million. Upside revenue synergies are expected to equal $115 million. Additionally, with the Shaw acquisition, Shaw brings in 3,000 new engineers to CBI. Therefore, that's a competitive advantage because CBI will have the largest engineering base within the industry. We also looked at the possibility of the margins declining due to Shaw's lower margins in the past. For example, operating margin for Shaw has been roughly 3 to 4%, and CBI's has been 8%. Therefore, we see a possibility of a decrease in margins. In 2013, CBI's operating cash flow will be a little bit overestimated due to the combining of the balance sheets, but we expect it to normalize in 2014 to $550 million, and we believe it will continue to increase to around $900 by 2017. Additionally, we believe that CBI will go back to its capital structure of 100% equity, 0% debt. They've done this in the past, and they've mentioned in a guidance call that they plan to do so early by 2017.
We use 3 different models for our valuation: EV/EBITDA, PE, and free cash flow. As you can see here, we have the EV/EBITDA. We have a multiple of 7, which is in the middle of its 5-year range. For EBITDA per share, we forecasted for 2017 and discounted back to the present. That gives us an EBITDA per share of about $12 and an intrinsic value of about 51. You can see off to the right our sensitivity analysis. We have different EBITDA per share and EV/EBITDA multiples. And at the bottom, you can see our model's estimated EBITDA per share growth. P is very similar. We come out a multiple of 14 for our future EPS. Once again, we forecast in 2017 and discount back to the present. We get a $6.59 future EPS and an intrinsic value of about 54. We have a sensitivity analysis for PE up to the right, and also at the bottom we have our model's estimated EPS growth. For our free cash flow, we use the CAPM to calculate the cost of equity and get a 11.8 KE. Combine that with our, as Mary Elizabeth discussed, our targeted capital structure of 100% equity, we get a WACC of 11.8 as well. That gives us an intrinsic value for our free cash flow of about 52. Up to the left, you can see intrinsic value estimates, or combined intrinsic value estimates at the bottom, 52. For our target price, you have to understand that the E&C industry, by nature, is highly volatile. So therefore, PE by itself would not be the best method to use. Therefore, we place more weight on EV/EBITDA, which gives us a target price of 57. I'd like to point out that we think 57 is a very conservative number, and we think there's potential for it to grow even more. But for right now, we're going to say 57, and that's going to just go hold.
Great, thank you. Opening up for 10 minutes of question and answer.
That's a question. You know, in any organization, tone at the top is very important. this acquisition of Shaw, did it have any impact on corporate governance and the structure of board of directors and with regard to the risk analysis and some the combined companies, strategic decisions in the future, sustainability and other things? Did you look into any of those?
So your question is, how will they operate as a
As it combined?
Sure. So they're going to keep Shaw separate, and for the most part, it will be its own business segment. And I assume that they will keep most of the executives on, but it'll still be under CBI governance.
I'm going to show you CMS. Chicago Bridge-Round has said they will, as well said, they will operate Shaw as its own entity. However, they will operate it as CBI operates CBI currently. You can see this is sort of the layout of how CBI operates the company currently. And they're going to go through all the standard reports, all the risk analysis that they currently go through. They're going to go through that with Shaw after they acquire them.
When you calculated the weighted average cost of capital, how did you come up with beta? How did you come up with the beta?
The beta.
Beta? Oh, well, I just like to point out, E&C companies have very high betas compared to other industries, but we took CBI's beta and Shaw's beta and we combined them for right now. And that's how we get a 1.65 beta.
Very good.
Related to the weighted average cost of capital calculation, after the acquisition, is there going to be any kind of debt financing?
Debt financing. So it'll be, the debt will be zero for 2017, so that was what we calculated into the WACC.
I would like to point out that CBI executives, I'm going to quote this from the last report, they are committed to deleveraging, maintaining a strong balance sheet. Therefore, as Mary Elizabeth discussed and I mentioned, we expect that after they acquire that debt to take on Shaw, we expect them to pay that off by 2017.
So if the plan is that they operate pretty much standalone, these two entities, where do the synergies come from, especially the cost synergies?
Lots of those will come from the contracts that they sign. So when they sign a contract in the E&C business, it's the services that they can offer. So now they'll be able to offer fabrication and manufacturing technologies that Shaw brings instead of having to outsource those or use another company. And then for the power segment, they'll be able to use some of those technologies and some of the engineers on those as well.
And for the revenue synergies, you can see we have, for each Shaw segment, or each segment in general, there are certain things that Shaw will bring to the table that will allow CBI to benefit from and achieve their synergies. And you can see those here, we got a $31 million synergy from F&M, 52 from power, 1.5 from clean services, 3 million from SBS, and mega projects from general synergy of 28 million. So once again, we project $155 million per year annual revenue synergies.
So you believe that this business combination would be sustainable in the near future?
Not only will it be sustainable, this gives them a huge, bringing in Shaw, it allows them to be a full provider of EPC, fabrication, maintenance. So now that one of the big synergies is now CBI can come in and not subcontract. They have an in-house EPC with Shaw, especially for stuff like power. Now they can also maintain those power plants after the Shaw segment goes through the EPC part. So it's a huge boom for CBI.
And that would also move into management skills that combine companies.
Absolutely, and once again, the integrated value chain, they bring in, I believe, an additional 1,200 project managers, including also, as we talked about, the 3,000 engineers. So it's a huge integrated value chain.
So I think you forecasted a 10% revenue growth.
Yes.
How did you come up with that?
Well, it's not 10%, we'd just like to point out, it's not 10% every single year. We think for the future, it's going to be an average of 10%. And once again, within the next 5 or 10 years, there may be a recession, something like that, but we're being conservative, we don't know that. And one of our big risks to the price target is that 10% might be lower. But that 10% You want to take that another thing and take that?
Yeah, 10%. So CBI has recently been seeing about a 12%, and Shaw's been somewhere around an 8% growth rate. We averaged those, and that's just for the next, through 2017. So it's just an average, and we said that it would fall somewhere in the middle, but that's subject to backlog, being able to turn that into revenue, and the award of new projects.
Yeah, but if we take the last 2 years, which saw probably a pretty strong bounce back from the recession, and forecast that out 5 years, it might not be the best approach, especially considering that U.S. GDP growth, on nominal basis is probably 5%, right? We're talking about nominal numbers, so you basically say these guys could grow twice as fast as U.S. GDP.
So you're suggesting I'm going to be higher than 10%?
No, what I'm saying is, it's pretty, hefty revenue growth rate. Also considering, if we had hit another recession in a couple of years, then these guys get hit very hard. I mean, if I look at historical financials, I think they got hit very hard during the recession, where their revenue dropped substantially.
And I mean, I think that is definitely a very good point, but they're also very internationally leveraged. They're 50% domestic, 50% international, and they're really exposed to a lot of the emerging markets. So I think
the emerging markets is the key. The China, the India, the Brazil, you're going to see a huge, absolutely huge increase in energy consumption and demand from these markets. With the acquisition of Shaw, CBI is highly posed to target those emerging markets and make a huge amount of money from that.
So do they have any business related to wind energy?
to wind energy. Wind energy.
When CBI does deal in wind energy, it's not a huge product segment for them, but they do deal in wind energy. I'm not sure, but
I'm not sure to what capacity.
yeah, I'm not sure what.
Yeah, because I mean, if their business is highly geared towards fossil fuel, right? I mean, the power plants that use fossil fuels, that might be an issue, in a couple of years when we have a more progressive view on that in the U.S. Don't you think?
And I think that's a great point. And then also, but then they also have the environmental and infrastructure of Shaw, which helps with those regulations and helps keep those plants up to standards and stricter EPA regulations. So then they can also benefit from that as well.
CBI and Shaw, they have already started in the past to begin to retrofit those plants to meet EPA standards. So they're already at the top of the line. So when the EPA, if they decide to overly regulate, not overly regulate, but continue to regulate, CBI is already at the top of that line.
You talked about the compliance risk, but what's the major threats against business combination in the future?
I think one of the biggest risks was, as you talked about, what happens if that 10% growth isn't there? What if there's an economic slowdown? And that will decrease our forecast.
And it caught some flack because CBI's, their expertise is not in power. So it's the ability of them to be able to get into that end market and do that successfully.
Okay, maybe a short last question. We have 1 minute on the time.
What perpetuity growth rate did you use to calculate the funding? And how did you come up with it?
With the growth rate? We use a 1% growth rate. The reason we use 1%, we thought that was once again, these are conservative estimates. What happens if there's a continuing slowdown? So we decided to go with a very conservative 1% instead of using like a 2% to calculate the terminal value on our free cash flow.
Okay. I think you built a 5-year model. It was a 5-year model.
The free cash flow is a 10-year model, to 2022.
All right, thank you very much.